Hello, everyone. Welcome back to the Rational Investor School for Trader Development. Here we are in our level 1 program, our introductory program, still slowly working away our introduction to building and working with a trading plan. And we're into part 4 of our eating our vegetables modules. And great to see we've got James in the video hangout with me. I see that he's active in the lounge. I see a few other students are helping out with posts of links. Thank you very much, Lincoln. Actually, I got to tell you guys, I'm really impressed with the way that you guys sort of communally have worked together to build this out and help each other with learning. And I'm also really impressed with what I'm seeing, sort of communal. You're helping each other within this lounge itself. It's really cool to pop in and just see you guys reviewing ideas. I'll tell you, I was very, very impressed with some of the crypto screeners that you guys have been building. And frankly speaking, I think some of them we might even ask if we can incorporate them into the site going forward. This Christian built one hell of a spreadsheet here, and a lot of people on the site are really really enamored, really impressed with the work you guys have been doing. Gotta tell you, I mean, it shows. The time and effort you guys put into this. The more you put into it, the more you're going to get out of it, and it shows. It really does. So way to go, guys! Very, very impressive. I don't know whether we're gonna have Julian here with me today, but like I said, we've got James here, my right-hand man, and I'm enjoying sort of the relaxed, sort of laid-back nature of this automated program. We're really what these group tutorial sessions should just simply be sort of Q&A to try and address some of the questions that you might have. Might take just 5 minutes at the top here and just, review what it is we were supposed to be doing this week and, where should we be sort of coming out the back end of this week. And then, like I said, we'll hop into your questions. And I see you guys have asked quite a few questions. We're going to be pretty busy tonight. And then I think like we did, probably wait for the Wednesday class to finish up any trailing questions that we don't get to tonight, and then go over the mini quiz exam, just to make sure that you have the right answers in your notebook. The first week of the program, that strategic planning, sort of the first sort of learning week, we had to cover a lot of information, a lot of material. So the little mini exam was pretty long. Hopefully you see that as we sort of work through the program, the little mini exams are a lot shorter. So, all right. So specifically this week, the way that we had sort of done the school program, and I used to like to have like a nice overview. I can't really give that overview image to you guys. It's a little frustrating. So maybe we'll have to make sure we have that for next time. But what I like to do is start off with just a conversation about strategic planning. Where are we in the world? This also gives you an opportunity to do a lot of self-examination and just, make sure if there's any skeletons in your closet, we make sure we get them out. But also, too, what kind of universe are we playing in? What are your different choices? Obviously, you guys are very crypto-centric. I mean, quite a few of you are. So where does that asset lie in sort of the big picture of, assets, and is it behaving the way other assets that are in that same class are? Hopefully you've gotten that message that, this is basically crypto came out of the gate sort of a commodity proxy and acting very much the way commodities have acted through this cycle. Nothing really out of the ordinary, but the key here for you guys is that we're actually at the end of a very long cycle. This has been like 17 and a half years. Probably most of you don't even recall what a growth cycle looks like. Either you just weren't participating in the market, or maybe you were just too young, which is fine, but what you do have to understand is the world is going to look very differently for the next 10, 20 years going forward. We also, unfortunately, have to acknowledge the fact that we are going through a transition window. And these transition windows can often be really violent, really ugly. The last fear cycle apex had, American hostages being paraded around downtown Tehran. The Soviet Union was at its peak and they were hosting the Summer Olympics. International socialism was at its peak. The previous cycle, the previous fear cycle, there was this crazy guy in Germany running around Europe trying to kill everybody and take all their assets. And that was right into that cycle peak. So, the sad part about it is these fear cycles often end very ugly. So just brace yourself. Half of the reason why you guys are interested in crypto to begin with is you've kind of lost faith in the system. And that really doesn't surprise me. I mean, it's sad, don't get me wrong, but, for the particular place where we are in the longer term cycles, it actually makes perfect sense to me. So let's not try and get too wrapped up in the fear and the pessimism and the end of the world conversations, right? The market is always going to be here. And really, our job is just don't put yourself into a position where you just can't come back and play the game again tomorrow. So don't take too big of bets. And actually, that's actually really our conversation today. The week 3 and week 4 were really to give you just a nice solid foundation of this concept called rational analysis. We wanted to introduce you to fundamental analysis and how fundamentalists look at the world. The easiest way for you to understand the difference between the fundamentalists and the technicians is that shopping mall analogy. I've never seen a better simple illustration of the way to understand the difference between the two. The interesting thing is some people are very numbers oriented. So what we often see happen is, they shy away from fundamental analysis, but I actually challenge those people that are really numbers oriented to try and turn the tables. See if you can do technical analysis on fundamental data sets. And I was showing the group charts like PE ratios, historical PE ratios. The guys in the lounge are always posting charts about, Jamie is super into fundamentals now, macro fundamentals, talking about debt to GDP and incomes and all that kind of stuff. So, if you want to try and wrap your head around that, try and hunt for M's and W's in those data sets. It's kind of a fun way to embrace fundamental analysis if just the raw printed numbers are kind of boring. So, week 3 and week 4 were basically your introduction to this world called rational analysis, and to give you enough tools that coming out of, especially with sort of your strategic vision, where are we in the big picture, where are we going, you should be able to, at the very least, come up with a very simple investment thesis. I buy assets because I like these fundamental criteria. And I simply hunt for things like M's and W's on the charts to help me time my purchases. And when I'm, hold on a second. When I'm, where was I? I lost my train of thought. Something distracted me. Sorry. Well, let's back up. So the point here is that we just simply wanted to introduce you to the fundamentals of both of these camps. And as I said originally, this course, this sort of eating your vegetables, was actually designed to be an in-person course taught to the continuing education program for the Canadian Chartered Accountants Society. So having that simple framework of what rational analysis is for, especially investors, you should be able to start building what are your 3 reasons to consider taking trades. And keep in mind, the accountants, right, they're super, super fundamentals. So long and short of it here, you at this point, you should at the very least be able to build a very simple framework for investing your money. I think I gave everybody the assignment the very first week of class. Hasn't changed. Nothing really should change. Does anybody remember? If you wanted to do something in the marketplace, what were you supposed to look for? And, the irony of it all is coming out of this introduction to technical analysis, you should have been given that in spades. I don't know if anybody can even remember what your simple assignment was. So, yeah, that's being a little bit smart-ass Burnsy. Hunt W's, very good. Casey, weekly W's was what I was really looking for. And like I said, for the chartered accountants, if they, like I happen to think that this stock is trading at book value and it's growing its earnings nicely, you throw in a nice little W on the chart pattern, boom, you get yourself a nice little investment plan. The week 5 here for the program was really sort of the dovetail of the introductory eating our vegetables part of the course, in that, and frankly speaking, I'm not even quite sure. We should have it in here somewhere. Is it in here? Let's see what happens if I show this to you. All right, we should all remember Brian's 2 rules of investing. And as I've outlined before to you guys, really, the 2 rules are just, me, doing this business for like 20, 30 years and just seeing where people constantly fail. And, everything about rational analysis and having, at least 3 unrelated reasons to consider taking a trade is everything about Brian's first rule of investing. Tonight's module, a big part of the conversation is really addressing this second rule of investing. And ironically enough, as I sort of probably told you in the lectures, this is where most people fall asleep, they lose interest. And yet, ironically enough, of the 2 rules, this is definitely the most important. And it's interesting, I don't know whether some people that I work with really like my style of trading, reload zones, divergences, structure, go. It's basically what I teach all of you guys. But those people that are like, well, Brian, I'm going to trade different setups, just primary alpha indicators, whatever. I don't really care. As long as your setup, your reason for taking your trade works 2/3 of the time, that's fine by me. But what I did find is that people really do appreciate this. Is a hard lesson to learn. And if you can learn this lesson, then the words like wrecked, they don't even exist in our vocabulary. And really, that's what I want to teach you guys, right? You should never, ever be in a position where you're like, oh, fuck, I'm wiped out. That it just shouldn't happen. And the irony of it all is that if you actually do these 2 rules correctly, it actually is quite difficult to lose money. That's the irony of all of this. It's actually difficult if you actually follow the plan, follow your setups, follow risk management. It's actually difficult to lose money. So anyway, so tonight's conversation is, week 5 is all about risk management. And understand too that this is going to be the end of sort of our eating our vegetables part of the course. And with that said, at the end of that sort of in-person presentation that I would do, for the Canadian Chartered Accountants if I was teaching it to them, a big part of this sort of finishing conversation with them is, all right, we now have a strategic vision. We now know what fundamental analysis is. We know what technical analysis is. We understand risk management. The only thing really we have left to do now is put it all together in a nice, pretty package. So even coming out of today, I fully expect you guys to have a pretty well vetted trading plan. I think, and I'm not quite sure whether we even, fortunately, I'm not totally fast on this stuff, but I'm just going to go back to the old site because, frankly speaking, I don't know where any of this stuff is. Just for speed purposes, I'll just go grab it from over there. The question is, where the hell's the damn page? There we are. So I'm going to go over here and then here, and then we'll go. Actually, I think, yeah, we'll go here. So coming out of tonight, and this is just a trading plan. We got a bunch of them on the site you can look at. If you're going to identify whatever market it is that this trading plan is going to address. So, by now you should have a pretty good idea of what it is, what market it is you're interested in. This happens to be a trading plan for OK Coin forwards. Your name, the date, that's pretty straightforward. Strategic, that's pretty straightforward. Who am I? Why am I doing this? Gotten some really good, documents. People have done some verbal diarrhea, and people have sent me messages, saying, Brian, how am I doing on this? And I've, put little notes here and there. So I do see people working away. This should be pretty simple now. You've had about a month and a half to work on this and start bullet pointing your various motivations. And now coming out of tonight, right, especially with the back half of the conversation here tonight, I'll put that away. Yeah. Back half of the conversation tonight is all about us running our small business of trading. So coming out of the back half of tonight's conversation, you should be able to clearly identify what market is you're interested in, what kind of capital it is you're going to work with, what kind of risk taker you are, and by definition, how does that risk look like? Have you given thought to commissions? I think it's a good idea. Keep in mind, when I first started in this business back in the 1980s, I used to have to pay $100 commission each side on an options trade. Now, obviously with crypto, commissions aren't that big of a deal, but I still think it's worth paying attention to. Risk adherence. Obviously, this has everything to do with what type of risk taker you are. So if you're little old ladying it, well, you might as well put right on here, I'm little old ladying, so I don't have to stress about getting stopped out. But it also means I better make damn sure that I never buy more than 5% of my stake into any one name. Here, obviously, we're doing leveraged trading, so it's a good idea that you make specific reference to stops. Again, building out our business of trading, especially the back half of this conversation, I should have a pretty good idea of what time frames I'm working off of. Don't put yourself in a position where, if you got a full-time job and you got like a wife and a few kids, don't be saying that you're going to be day trading OK Coin off of the hourly chart. That's just completely unrealistic. So be very specific about, what your business is going to look like. Am I going to use conditional orders? Do I have to make sure that my open orders are set for like little old lady sell halves on a doubles? I thought it was really fun. You guys want to see something fun? This is hilarious. And really, there's no reason why all of you guys can't be doing exactly the same thing down the road. But I had a little coin that we just went and bought a little bit of it. Didn't really get that much of a fill. But I did notice there was a gap way up top on the charts. And so for this particular trade, I just outlined before I put the trade on, I just simply said, you know what, we only got we only picked up a little bit, not that much, like, 0.015 BTC, not much. But I did notice this little gap up here, and so I said, what the hell? We're just going to work our open order at the gap. Gaps like to be filled in. You'll learn that later on in the course. And sure enough, boom, I just got a 13x on a trade. There's no reason why all of you can't do exactly the same thing here. No reason whatsoever. So, but the key here is the only way that you could do this is you had to plan, right? You had to make sure your open orders are working and, constantly go in and make sure the accounts are nice and happy and stuff. And you just have to review. But the point here is that, are you going to make reference in your trading plan to exactly how your orders are going to be placed? I think it's a good idea. I think also too, we should take some time and just let's think about all the various different things that could go wrong ahead of time. What happens if I lose internet connection? What do I have any personal health issues that I should be aware of? What happens if one of the kids gets sick? Right? Do I have a plan in that for that condition? Right. So that's why I say additional considerations. Me personally, I used to always get sucked into taking trades into what we call kill zones, and you'll learn about this later on in the program. And I just had to make an actual outright effort in my trading plan to highlight the fact, Brian, do not fucking put a trade on heading into a kill zone. Don't do it. But, those are the kind of things, that's what the trading plan is for. If you happen to see that you're making mistakes, or, you're new, so, maybe the notes here just go really slowly. I'm just starting, make sure to paper trade, 20 paper trades, whatever. A setup. It doesn't really matter. The trading plan here, though, I hope you're all seeing this, is that by this time in this course, almost everything here can be filled out. And it's not that long. The only thing that's really missing from this trading plan after today's conversation is this one line. That's it. And the interesting thing, like I said to you before, you now have enough knowledge base from the introduction to fundamental analysis, the introduction to technical analysis. You could technically start building what are my 3 reasons to consider justifying risking my hard-earned money in the market. Obviously, part 2 of this program is all about teaching you this fun stuff and what are sort of the various different tools that we use. But I hope everybody understands, and really, you have no excuses. We've been working together for a month now. To all intents and purposes, most of this trading plan can basically be filled out by the end of today's class. If there are any sort of lingering questions, well, that's exactly what this was supposed to be for. And I see we've got quite a bit of work ahead of us here tonight. So, and by all means, if you still have a question after tonight, get into the document, put the question down, and we'll attack it Wednesday. If you still have a question, can't figure it out, you can always PM me. As you can see from my little Rocket Chat interface. What am I recording? I better make sure I'm recording the right thing here. Yeah, okay. So I'm still, James, you still there? How you doing, bud? Still with me? All right, well, I hope he is. Hey, there he is. He's over there. You're all over the place, aren't you? Anyway, as you can see, lots of students are PMing me. So I have active conversations going on with a lot of you. I don't have a problem. Like we got James here. Totally awesome. Nicest guy in the world. Garrett, I think, actually is on vacation in the Caribbean right now. But I suppose when he gets back into town, he'll be a little more active. No big deal. We also have Julian. I don't know whether Julian's here tonight in the lounge. But he's also here to help. We have Graham. Graham is a fantastic guy. Thomas on the site. These people are super nice. At the very least, they might just be like, well, I don't know if I can answer that or not. But they're not going to, tell you to F off. James here specifically is TA in a program. He's here to help. Garrett here to help. Julian, definitely here to help. I would say, though, he's more of like admin and sort of the architect of this automated program. So let's maybe go easy on stressing Julian right here. But then, of course, good old Uncle Brian, right? I'm here, ask me, and you can see people do ask me all the time for help. It's what I'm here to do, right? Okay, so with all that said, I hope you guys are feeling like you're getting good value for the course. We've done just a simple overview of what it is we're going. Well, actually, we didn't. So we actually talked a little bit about this part. Let's just take a little, just a moment and just review what it is we were supposed to be covering here this week. Pops, Brian. Hey, Robert. My apologies. Julian actually usually sends out the email invites. And he was feeling kind of tired tonight, and he took a little nap, and I sent it out, but I totally fucked up the email, and I sent everybody not blind carbon copies, but just carbon copied. So I saw your message, Robert. Brian, strike two, eh? Geez, Robert's probably losing a little faith in good old Brian. I'm dropping the ball big time for him. But hopefully, at least we're learning this stuff here, Robert, and you can get value out of the course rather than Brian giving you the runaround on tutorials and screwing up emails. Sorry, Chief. Okay, let's get to work. I just saw you there, and I did see that note earlier. I apologize. It certainly wasn't intentional. I hope that wasn't too egregious of an error on Brian's part. Okay, so what is it we were supposed to be talking about tonight? Really, as I had said earlier, Brian's 2 rules of investing. The second rule, ironically enough, is usually more important, more significant to your longevity at this game than rule number 1. We have to understand that first and foremost, we are human beings, and it's actually not healthy for us to assume that we're not going to be human beings. We're these funny little chemical creatures where, because we had to survive out in the wild, on the savannah and stuff, and kill stuff, and our brains are actually built very emotionally. We're rewarded for continuing to hunt. Our brain produces chemicals that make us feel good when we're in that sort of stalking mode. But at the same time, too, those brains are subconscious. It's constantly looking out for us because those saber-toothed tigers, right, they come along, chomp you, and you're bye-bye very quickly. So, your subconscious is built through, all the millennia of our evolution to keep us out of trouble. This ends up being one of these sort of funny little vortexes that we're trapped in as humans. It's we have 2 emotional responses to everything. And the funny thing is money brings out the most base emotions in people. And we have to understand there's just these 2 simple words. And as soon as you get this, then the whole speculative process makes complete sense. And ideally what we want to do is flip the equation around. So when everybody else is fearful and they're shitting their pants, that's when we are like, okay, well, maybe it's worth taking a risk because they've all been wiped out. And then conversely, when the public, the lemmings, are all excited and rah, 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 well, maybe we should be like, you know what, this looks maybe too good to be true. Let's maybe pull back. The interesting thing with this, right, is that there is no wrong way to approach this. And nobody's holding a gun to your head. And frankly speaking, I'm going to close the window now because now it's getting a little chilly. I'll be right back. Hold on a second. So, you can, school teacher, post office employee, I don't know, tax collector. You could go through life not even thinking about the market, not even thinking about speculation, not even thinking about the capitalists and all their crazy greed and fear talk. Nobody's holding a gun to your head to participate. But if you are going to participate, you might as well do it the right way. So, in the first module, we talked about the importance of planning and the importance of, quantifying your actions ahead of time. The bottom line here is to be able to act in your best interest, i.e. buying when everybody else is shitting their pants. That's very difficult. And really, the only way that you can do it consistently on a regular basis is to plan ahead of time. And it's great because what I see happening now in our community, and this is just fucking, it's poetic. It's beautiful. Literally, we've got an army of traders all doing the right thing. And so when we wake up, when I wake up in the morning and I turn on my screen, the market can be horrifically down. And yet we have a whole bunch of really excited people. Oh, I got this fucking awesome fill. Look at this fill that I got down here in the gap. Oh, look at them. They're totally panicking and dumping, right? We got filled. Yay. and James, right? Where's your video? James has got his Macklemore video. I mean, it's just perfect. It's so perfect. So I've got the message through. Now, the irony of it all is that you guys, we've actually spoiled people because now we've got a whole community of people doing it the right way. Opportunity is now here when everybody else's opportunity is nowhere. So you might actually get a little bit spoiled being around TRI because you don't realize that most of the public, when we're actually interested and we're excited and we're buying, most of the public is dying 1,000 deaths. And the only way you can do this is you just have to have a subconscious belief in your skill set and what you do for a living. And that will come with time for you guys, no doubt about it. The whole point of us, paper trading is we don't need to like hold a gun to our subconscious's head. Take some time, take a cycle or two to convince your subconscious of the validity of this. Yeah, isn't that? It's such if I play it though, then YouTube gets all pissed off, so I can't even play it. I'm glad I stopped myself. Opportunity snow here. Thanks, Jonas. Okay, so we have decided that we are going to participate in the capitalist process. It means that we do have to live with a world of risk. You just have to. That doesn't mean that you're guaranteed to lose money. If anything, this guarantee of risk should actually open up windows of opportunity. But you just simply have to understand that, in the financial services industry, we cannot use the word mitigate when it comes to risk. You just can't. So we can take a bunch of steps to minimize risk. And then here we wanted to go through and just sort of, talk to you about the different ways portfolio managers minimize risk, and introduce you to this concept called the efficient frontier. We talked a little bit, we introduced a little bit to you when we talked about intermarket analysis relationships and correlating versus non-correlating assets. In essence, a portfolio manager just simply wants to buy a whole shitload of non-correlated assets. And then that way, think of the lava lamp. If you own a little bit of everything and it all sloshes around, well, at the end of the day, you come out just basically even. And they actually mathematically proved that you can actually get higher returns if you have, and with lower risk, if you diversify versus just owning one asset outright. And a couple guys won a Nobel Prize in economics for that. We also really wanted to talk to you about you. And I know that sounds kind of weird, but ironically enough, to actually set you up for success, we have to turn the tables. It's not really about Brian. It's not about James, not about Julian. It's about you. And we have to, you have to be really honest with yourself. Some people, they thrive in risky situations, in anxiety situations. Some people are like that. Other people, no dice. I think I've told you repeatedly, especially, introduction of fundamentals, technicals, right? Yeah, the most important thing that all this comes down to is personal fit. And I can absolutely tell you, if you are not a risk taker and somebody throws you into a position where you have to take relatively high risk and the odds aren't that great that you're going to come out ahead, I would say that that's not doing you any favors, and you'll end up fucking up, fat fingering, doing some, just crazy outlandish stuff, and afterward you're like, I can't believe I did that. just because the risk, the anxiety around it was just too much for you. So a big part of this week's conversation was you have to seriously look in the mirror. The good part about investing in what we do is you don't have to go balls to the wall. Nobody's holding a gun to your head. You can participate in the capitalist process like our little old lady nanny nibble strategy and not ever worry about getting stopped out. It doesn't even exist in your vocabulary. So really understanding the different type of risk takers there are and who you are and where you fit into that category is a monstrously huge part of this equation. I would even argue probably the best thing for all of you is to start out as the minimum risk taker. Just don't even consider being a high risk derivatives trader, futures trader, margin trader until you've actually run a very low risk portfolio, made a whole bunch of money, and then with the market's money, then you go and practice being a margin leverage trader. So then that way, even if you do lose, it's the market's money you lost. It wasn't your money. And I do find that a lot of my students go down that natural road. It's a very easy, natural progression for them to make. For those that are like, no, Brian, I want to learn how to leverage trade, futures trade, that's fine. We can start with paper trading. Get really good at taking the setups. Then move up to 1/10 the size of the account so that trade sizes are still really small. Get your subconscious believing, okay, I can do this, right? And then, good 20, 40 trades down the road, you're now trading like 1/10 account size. Got a nice 60, 70% win-loss ratio, nice 2-to-1 risk rewards. Your subconscious is believing. Then you can go up to full size. But the key here is we have to figure out what type of risk taker you are and how you handle risk. If you can't handle risky situations and anxiety, my advice to you is don't do it. Simple as that. All right. So, and then as I said, the second part of our conversation tonight was after we sort of had a good conversation about risk, we wanted to sort of wrap up this week with, all right, how are we going to frame ourselves going forward? And I think it's actually in all of your best interests to consider yourselves little business owner operators. And, the ultimate objective of all business is to make a profit. There's no reason why you can't think of your trading as exactly the same thing. What are sort of the key attributes of successful small business owner operators? Can we identify any of those attributes in ourselves? Can we identify any of these key attributes that maybe we're lacking a little bit in? And if that's the case, how do we build plans like you saw in this particular trading plan? I used to have a major problem with taking trades heading into kill zones. And so, this is an example of building a support in my plan to take advantage, well, not take advantage, try and address a clear shortcoming that I see in myself. So the point here is that the trading plan, as we go through all of these sort of what am I good at, what am I not good at, what could I use a little bit more sharpening up on, what could I, maybe even be a benefit to my community because I happen to be really good at something like, discipline. How can I leverage those skills? And how can I build supports in my plan for the skills that maybe I'm not so good at? All right. So, and then as I said, really coming out of this week, really now all we really need to do is just start putting it all together. Start putting all the pieces together. And the only thing out of this one whole page that's missing here is, in this particular case, what does my actual trade setup look like? That's it. Everything else you should be able to outline here by this point in this course. Okay, so let's head on over and look at your questions. And, we got a good hour and a half here to work with. Whatever we can't get to tonight, we'll just sort of pick up on Wednesday's session. And like I said, on Wednesday, we'll go through the exam, make sure you have those answers as well. So let's, do we want to take a quick potty break or do we want to just jump right in? Do I have a typer assistant here all ready to go? I'm not quite sure. I got to tell you, I was pretty damn impressed with whoever was doing that before. That was a damn fine job you've been doing. I think we had a couple people doing it. Vape break. Okay, well, let's get to work here. All right, so when not in an active trade in a crypto space, aside from keeping your money in one, fiat, which incurs large commission fees, two, BTC, very volatile of late, or three, USDT, Tether, not sure if it's an asset backed as it claims, are there any other less volatile, stable assets in the crypto space we might consider? Simple answer, no. I think you might be able to in the near future on Bittrex. I think they are introducing US dollar. So I totally agree. I mean, on balance, the easiest, simplest solution for us would be this USDT. But there are some people in this space that are just fucking hell bent on trying to bring this USDT down. I got to tell you, for as long as I've been in this space, the USDT has worked perfectly fine for me. But man, talk to people about this USDT, and it's almost like you're insulting a family member if you say that you like it and it's fine. As soon as Bittrex gets the US dollar sort of basing, my hunch is we probably will leave this USDT completely. There is there was one on Binance they were trying to do. I think they called it BNB. But the problem is this silly thing just got bid up to like just staggeringly high levels. So, and there's also things like that SBD, which was supposed to be exactly opposite to Bitcoin. And it's supposed to be trading at $1. And you can clearly see it's trading at like $3 or $4. I mean, completely skewed. NBT is a pretty popular one. You might want to consider that one as well. But as it stands, believe it or not, the most efficient one that I see right now is this USDT. But it's very unpopular in this space. And this is a perfectly good question. And I think, BNB's back down to $5.15. There you go. So, yeah, I mean, I don't even know what the hell that thing is. I have heard people talk about it before. There's also BRK or BRX. It's sort of that same thing as SBT with Steam. So those are also, but as it stands right now, this is about the most stable thing I've seen that's supposed to be sort of an anti Bitcoin kind of thing. And like I said, it's extremely unpopular. It's BRK or BRX. I can't remember one. I mean, just pull up the symbol. You'll see it's just trading at $1. I suppose we could just pull that chart. Oh, well, we got so many questions too. So yeah, just whichever one is trading at $1. And there's also SBD. If you want to write down SBD, that's also another one. But again, it's trading at a huge premium. Okay, question regarding rule number 2 and the 5% max position size risk. Suppose I'm running two strategies in parallel. Strategy number 1, conservative, accounts for 80% of my trading funds, and strategy number 2, riskier, is 20%. Would be fair to say that in strategy 2, I could take a 25% maximum LOL position, and it's still respect rule number 2. 20%. Yep, that's correct. Yep. That is 25%. Yeah, that's correct. Yep. So, wow, that's nice and easy. Phew. Okay. Yes. On to the next one. I would appreciate it if you could run through more varied examples of buy-sell options and how you would use these options to cover insure against a much shorter time frame, i.e. lower than a month, when hunting longs and shorts in the market? Will you use them, advise TRI members to use them if when BTC options are introduced? Well, to be perfectly honest with you, this is a level 3 conversation. I wanted you to understand in this level 1 program that you can buy insurance policies on your portfolio. And ideally, once BTC gets its act together, we should have option eligible exchange traded funds that should give you the ability to buy insurance policies. And I think it's best for you to stick to long durations as just a simple insurance policy play. That's what I really wanted you to learn in this level 1 course. With regard to actually buying, selling, trading options on a lower time frame basis, this is definitely advanced conversations. And frankly speaking, I don't mean to be rude, but I don't think you guys are even at a place to even have these kind of conversations. And I don't want to have these kind of conversations with you. Options are extremely risky. Most people lose money trading options. And frankly, I don't think any of you are ready to even consider trading options. For those people that have worked with me for a good 6 months or so and can make it to the level 3 program, I'm more than happy to start talking to you about options at that point. You've demonstrated to me that you can work with trading plans. You've demonstrated to me that you can work with risk management. You haven't blown yourself up, and you're ready to have those kind of conversations. Right now, you're just not ready. Sorry. And even Julian here, right? Julian, he has a option spread strategy that I'd really like for him to talk to the level 3ers about. But you guys here, it's just not in your interest to go down that road. Ironically enough, trading options at this point where you are is actually setting you up for failure. Very, very dangerous. And most people lose money trading options. You have to understand that. So put away the idea of trading options for the time being and just try to understand the idea that you can, Quinn, if you want. Quinn, did I send that? And the funny thing is I screwed up the email earlier, but I went in and actually purposely tried to find your email and change it to the right one. Did I at least get that right? Are you there, Quinn? All right. Anyway, I see Quinn was in the lounge there, and she asked, "Oh, I did get it right! Yay! Awesome! Oh, look at that! And I even get a happy face! Yay!" So Robert, see that? I didn't totally fuck this up. I actually helped somebody tonight. Okay, number 4. Our week 5 assignment is to submit our trading plan. Who should I submit it to and how? Should we continue to do this on a weekly, monthly basis moving forward as our plan develops? All right, so we've got James, we've got Garrett, we've got myself. Julian is really overwhelmed right now, and we're just massively blitzed with work. So let's maybe hold off on blitzing Julian here. But if he's up for it, I don't really have a problem with him reviewing your trading plan as well. So the primaries for you in this course, your contacts, James, Garrett, myself, and Julian. But as I said, let's maybe, we don't need to hit Julian too hard here. Any one of us, and people have been submitting their trading plans. I showed you guys how many PMs I get from all of you guys. I get tons. And you also have probably seen on the daily brief, sometimes I load up the site chats and it's just a wall of messages. So, that's what all that messaging stuff is for. And you're in the level 1 course. So this is what I want you here for, right? So the bottom line here is, yeah, and also too, as we sort of go through, yeah, you can, Oscar, have you seen this? Right, I got all these people that send me all documents all day long here, eh? I don't know whether you can see that or not. So feel free to PM me, James, Garrett. I don't know whether Garrett's on vacation right now, so maybe we'll wait till he gets back to give us a green light. But I know you can hit James hard here, right, James? I'm volunteering him right now. He's sitting there going, What the hell is he saying? But yeah, that's why we're here. Hey, there he is. Right? That's why we're here, right? So, and you see how big this trading plan is. It shouldn't be rocket science. Do you think that's going to take very long for any one of us to look at and go, yeah, it looks like you're heading in a good direction, right? I mean, it's these trading plans don't need to be like a thesis, really. And actually, a lot of what I have to do with people is just say, okay, now bullet point, drill down, drill down. There you go. Come to me and get my attention. There you go, James. Awesome. Okay, hopefully that answers that question. Okay, if we translate the notion from efficient frontier to crypto, we could compare small cap stocks, most risky assets to shalt coins. Okay, and T-bills, most riskless assets to what? Oh, good luck. You gotta, at best, we would say like Bitcoin would be like gold, right? And Ethereum might be like crude oil, right? And shitcoins might be like broiler chickens, right? They're all sort of in that one asset class. You can't really. The whole point of T-bills is that this is principals guaranteed. Are there any of these cryptocurrencies that are going to guarantee your principal for you? I don't think so. So I know you want to go this route, but we can't really. I would say though, you could do like a food chain, Bitcoin and Litecoin, and the top 10 sort of market caps being more conservative. And then as you go across the spectrum, more, shalt coins, right, being the more sort of speculative side of the market. If anything, efficient frontier, you could think that, stocks themselves are in the risk category, but within stocks, there's like IBM and Microsoft, and then there's, Joe Bulletin Board Pink Sheet, right? So think of it probably that way is a more accurate way to think about it. Yeah, I mean, this would be like more, financial planning, bigger picture, all that kind of stuff, right? Well, I mean, we sort of did that for you on the site. I don't know whether we have access for that to that old stuff here. Let's see. Where is it? So I didn't really want to get too much into financial planning because, frankly speaking, that's not the purpose of this course. But in essence, we just wanted to, just give you a general overview. Take your age, subtract it from 100, and that should be your maximum risk exposure. So, things like corporate debt, government debt, cash, this is all, principals guaranteed, right? That kind of stuff. Then as we go sort of down the spectrum, here's equities. We talked about, BM could be more conservative equity, bulletin board pink sheets, more aggressive equity, but it still falls under the equity category. And, let's call a spade a spade. Voltaire, he's basically said that crypto could all go to zero tomorrow or a fraction of current prices. So you need to understand, I personally believe crypto is totally in this commodity category. It is the most risky, most speculative part of the market. And, there's some coins like Verge. Everybody's excited about Verge. It's like 800 sats. And you got to remember, guys, I bought that Verge at 2 sats. So is there any risk at 700 sats? Somebody says, well, it was as high as 2 or 3,000 sats. So it's come down to 700. It must be cheap. And I have to remind them, hey, I bought the damn thing at 2 sats. So, yeah, even at the current prices in commodities, this is still a risky asset, crypto-wise. So I do fully appreciate that you would like to build this efficient frontier. I'm going to have to say, though, that, crypto itself basically falls into that commodity, very high risk, speculative part of the curve. And really, I look at like all of our altcoin holdings as basically spec assets. It's why they've gone up as much as they have, right? But at the same time, too, are they bonds? No. There's no principal guarantee to this whatsoever. And if you want to diversify, my advice to you is just simply get your money into cash. Cash is king, right? And if you want to go and, there's some kind of fun proxies you can do on the side. There's these SALT loans. Have you guys ever heard of SALT loans? So that's a way where you can actually loan people your capital and collect interest on it. So that could be like a fixed income proxy. You can buy Vault, right? You can buy gold with your crypto. I don't think there's, obviously USDT, and there's a lot of sites like Bittrex that are trying to introduce US dollar into their trading, so that you have that ability to diversify. But really, I haven't, if anything, maybe I would say like that SALT is the kind of thing that might sort of, satisfy that sort of fixed income side of the equation. You could even argue to a certain degree these master nodes are in a way trying to create an income stream out of crypto. So you could think of as investing in master nodes as another way to diversify. So we've given you a few different things to think about here. So maybe go back and watch that later on, and write down all the different assets that I gave you to try and diversify in the space. There are a number of different options for you. Okay, I'm following a trading plan which is mainly the LOL risk model. Okay, but I have a problem to set my half on the double exit limits when I bought against BTC ETH. And will sell against US dollar to prepare the liquidation on the main event of the trading portfolio in June, July for seasonal reasons. Investment for the dark season, only 20% after my experience. All right. I even think about liquidating a risk-free position to avoid losses. Do you recommend a permanent adjustment, or would you simply convert the entry? Same price, or do you suggest an approach? Well, it really all depends on what your objective is here. Right? The irony of it all, from my original objective of this, my little old lady approach was to just simply, I wanted to be long crypto, and I wanted to build my Bitcoin balance. And I've achieved both of those. Ironically enough, Bitcoin's price itself has gone through the roof. So as a result, the portfolio returns are just ridiculous. But if anything, you probably should start off with, what is your objective? Is your objective to, accumulate massive positions in crypto and own this space? Is your objective to simply increase your Bitcoin or Ethereum holdings? Is your objective to actually increase your monetary, fiat net worth, or your fiat holdings? It's probably a good idea to try and identify what your objective is, and that should be a part of your trading plan. Once you've identified that objective, then it's actually pretty easy to answer this question. So, really, I don't mean to turn the tables on you, but that's whatever the answer to that question is, that's what's going to actually dictate what you do here. Is it okay to just make a plan that, hey, I see that alts seasonally like to rally into the summer, so into the summer, I'm just going to build up a big old fucking pile of cash, and every time these things pop, I'm just going to grab the profits and park them right into cash? Sure. Nothing wrong with that at all. Just the issue here is you have to identify what it is you want to do. What is your objective? I think probably a lot of people are misconstrued or confused by my portfolio, assuming that what I'm doing in the market is what they want to do. That's not the case. In fact, I know for certain Julian would have preferred that I be a little bit more active on the sell side in December. I took a pretty laissez-faire attitude about the market, and there are some of us in our midst that did just basically go to cash in that December rally, and hindsight's always 2020, and so they're looking golden. Right? But that wasn't my plan from to begin with. And the most important thing here is if I'm going to be a good role model for you guys, I have to lay out what my plan is and then just simply stick to the plan. Okay, I hope that answers that question. It's a very good question. Don't get me wrong. Very good. All right, in the CBOE options purchase demonstration for insurance, you stated that each option was for 100 shares. And really, this is a question on what instrument you actually chose to study. Some people actually went and got the options on the S&P index itself, and then the multiplier is different. I was doing off of the spiders, which is the SPY. And so the spiders, SPY, is the ETF, the Spider ETF, and these options are on 100 shares of the Spider. So just be careful of that. 100 shares is this standard? Oh, good. Okay, so at least I answered that. Yes, if it's a stock, then the standard is each option is on 100 shares. If not, how do we find that information? And frankly speaking, let's just stick with stocks, stick with the ETFs. We don't have to do the indexes. You'd have to go each product by product and pull down the specs to determine what the multiplier is. And in a level 2 program, we go into futures and, we talk about spreads and all that. And, when you go into the futures markets, all of the multipliers are different. Every contract's different. It's a total fucking pain in the ass. So for you guys, let's just stick with stocks. Chicago Board Options Exchange. If we pull an option down on a stock, industry standard is for 100 shares. And then that way, the multiplier on all of these prices is really simple. It's just 100 times whatever that price is. I noticed at the top of the option list, the size was 40 by 25. What does this mean? Video number 1, 56 minutes in. Oh, boy. Oh, I haven't got a fucking clue what you're talking about. My hunch is it's probably the bid and offer on the actual option itself. So I wouldn't be too concerned about that. Each option, basically that's 40 contracts bid, 25 contracts offered. And like I said, each option is on 100 shares. So technically 40 contracts would be on basically on what, 4,000 shares? And so 4,000 bid, 2,500 offered. Not exactly sure what you're making reference to here, but I wouldn't be too concerned about that. Really, the only thing that matters to us is the price. Okay, if you consider cash the safest place to keep wealth in theory, excluding Venezuela-like scenarios, to take risk reduction a step further, would you not choose a country that has very little national debt and a large GDP to reduce the risk even further? For example, less likely to follow a Venezuela-like scenario, as opposed to USD. Would you do FA on fiat? Take it even a little further. For example, why is the country's debt so low? Are they commodity-based, industry-based, etc.? And work that into the economy as moving fear, greed cycle. Excellent analysis. This obviously is somebody who is much, much more informed than most of the people that come and take this class. I would agree with you. I think this makes complete sense. in that, how do we say this? Countries' cash is relative. What's this? That whiskey on the rocks Brian is having and keeps making noise in the glasses. This is orange juice. Why would I drink alcohol while I'm trying to talk to you guys? You're silly. No drinking. I'm perfectly sober. Anyway, back to our conversation. Cash is relative, and the riskiness of cash is relative. I think probably even better scenario for you to think about is Germany in the 1920s. And the irony of it all is, 20 years prior to that, Germany was like one of the predominant countries in the world. Basically went head to head with the British Empire, right? And in a very short period of time, and think about it, if you were a German citizen in the 1890s, 1900, 1905, 1910, would you ever think that your country's currency was worthless? And yet that's exactly what happened. So am I going to sit here and say, just put all your money into the mattress and, stuff it under the mattress and you'll be perfectly fine? No, absolutely not. That this is actually where we get to the kind of conversation of efficient frontier. This is why the efficient frontier works, right? Because if you put all your money into one asset and that asset underperforms, diversification obviously gave you far less risk. And actually, and the mathematics they proved it, your returns actually are better if you just spread the risk out. So holding all your money in cash in one country is extremely dangerous. Now, you've actually talked about a couple different scenarios here. There are countries like Bahrain, for example, and the Sultan of Brunei. They actually have currencies, and they are extremely strong currencies, and their currencies actually trade at a premium to the US dollar. Why? Because they have no debt, and they're sitting on a fucking mountain of oil, and they're just gushing oil. And people come to them and say, here, take my money, take my US dollars, we want your oil. And they say, okay, fine, we'll just keep taking your US dollars. And the currency gets more and more and more and more and more valuable because they're sitting on a bigger and bigger pile of US dollars. And they have a problem. At some point, they go, we got too many fucking US dollars. We got to go buy some Japanese yen. Let's go buy some British pounds. Let's go buy some Russian rubles, right? You could argue that in essence, the Americans propped up the Chinese by buying their cheap goods, and they paid them in the form of US Treasury bonds. And at a certain point, the Chinese said, all right, well, now we have to start diversifying and selling US Treasury bonds. And they started buying gold, and they started buying property around the world and oil assets and whatever. So I don't ever think it's a really good idea to be invested 100% in anything like this. I definitely think that the underlying fundamentals of the country are definitely going to drive the value of the currency. And remember, in our very first conversation, you asked the question, would you do FA on fiat? Well, do you remember our very first, well, I guess it wasn't a first class, maybe it was a second class. But I showed you how to do fundamentals on fiat and how I used to, as a broker, used to trade the fiat currencies. And in essence, they are basically based on the idea that if your economy is strong, then that means that short-term interest rates are going to be relatively high. And what ends up happening is capital just sloshes around the system, chasing whoever's economy is the strongest, which is in essence your conversation about GDP, right? Whose GDP is the strongest? And you're going to want to avoid whoever's GDP is the weakest. The problem here, though, is that technically none of these fiat currencies are worth anything. There is no intrinsic value to any of them. And it's not like the US dollar is so great. It's just that in this fiat system in 1971, they set up the US dollar as sort of the hub, the center of all of the spokes. Goes through the US dollar. And keep in mind, in like 1975, there were serious questions as to whether the United States and the Western countries were even going to survive much longer. Right? They were on the outs. Vietnam was a really bad experience for the West. So you got to understand that in that kind of scenario, the Americans, they were playing defense. And everybody was like, oh, fuck. Are we going to be the next satellite province of the Soviet Empire? So it's not really like they built the system out of, well, what's the best way to do this? I think they really built the fiat system out of like, oh, fuck, we're in trouble here, man. What do we do? All right, rally the troops. Right? And everybody, of course, circle the wagons around the strongest country, which happened to be the United States of America. The ironic twist of fate, history, whatever. It turns out that Soviet Union collapsed, communism disappeared, and the Americans won. And ironically enough, I bet you a lot of the Americans are going, fuck, man, I wish the Cold War would come back. Those days were so easy. It was so nice and simple to have, okay, we know who the enemy is. We can, anytime we want to spend more money, just, saber rattle. Oh, the Russians are coming. The Russians are coming, right? They can do anything. So, this U.S. hegemony coming out of the end of the Cold War, this whole fiat system, the fact that these currencies are basically worthless. Ironically enough, I think these days are numbered. We probably 20, 30 years from now, we're probably not going to be living in a world like this anymore. So if anything, what you really have to do is, like, did you watch that documentary, Doug Casey, not documentary, sort of a shill. He's talking about the Fed coin, right? The irony of it all is that the gold bugs now are already starting to draw the battle lines with cryptocurrency because they think cryptocurrency is actually going to be a tool of the state to try and control society. So ironically enough, we can actually even start to see the world is moving away from this fiat system. It's fascinating, really. We live in exciting times, I'll tell you that much, guys. I sure hope that helped answer that question. That's a big question, right? That's not an easy question to answer. Whoever asked that, if I didn't answer that, there it is. Thank you, Lincoln. And keep in mind, everybody, when you watch that video, this is a total shill for his newsletter. But at the same time, too, I think he makes some pretty interesting points. Okay, is there a way to find out how the USD is valued or overvalued? For example, why is the USD worth NZD 136 when the US jet to GDP is 106 and NZ has 34% of GDP? Yeah, really, these are really difficult questions, guys. These aren't easy. I would argue that to a certain degree, New Zealand is sort of painted with the same brush as Australia and Canada, South Africa, Russia to a certain degree, as we are sort of looked at in the world as sort of commodity nation country currencies. There are a lot of people that think that the New Zealand dollar is extremely undervalued. But the question, I've actually found that the New Zealand dollar, it actually gets more of its cues based on where it's trading in relation to the Australian dollar. And the Australian dollar has, it's sort of, it's marked. Do you remember, like I showed you in this sheet just a minute ago from our broker days. Notice that Australian dollar and New Zealand dollar often move in tandem. And interestingly enough, they're sort of like considered the shopping center, if you will. And New Zealand's not really that. They got a lot of lamb, I suppose, right? And a lot of wool. I don't know what other natural resources that New Zealand's really abundant in, but they're sort of considered like the supermarket to Asia. Kind of like Canada is considered the supermarket for the United States. And Russia is actually considered the supermarket to the Europeans, even though the Russians don't like that much. That's another conversation for another day. So these are, I mean, very good questions, right? You could go all the way to the fucking head of the IMF and say, "What the fuck?" and they wouldn't be able to answer this question. That's a tough question, and probably I don't know whether it's really relevant to this week's conversation. No offense, but anyway, answered it anyway. Okay, for example, if you have $100 and there's 1 million in existence, what? Yeah, $100. Okay. They often say that right now, and where is it? I can't remember. I think it's going back to the U.S. Revolution War, the Revolutionary War. But it might just be no. It's from the inception of the U.S. Federal Reserve Board in 1913. They say that the United States has lost 97% of its purchasing power from the inception of the United States, the Federal Reserve System in 1913 or 1910 or whatever. So I totally agree with you. And really, we've made this argument. This is the whole reason how democratically elected politicians can keep their jobs, is that they will dilute the purchasing power of the currency to keep the economy and to keep the stock market going. And that's exactly what we see in the stock market right now. The Dow has no business in this cycle making new highs. The only reason that it is because they just diluted the shit out of the dollar. So as a result, it's more of an accounting trick. Well, no, because what you'll see happens here, again, this really isn't risk management. So I think we probably should just leave that for now. You're getting into semantics here, and this is really all about that strategic planning part of the course. What can I do when I have a question related to last week 4 themes, since they shouldn't be answered here? The lounge or in PM to people like James? Yes. All right. I like that answer. Just, PM me. PM. James pretty good. Garrett's really smart. Other people, Grim, he'd be happy to answer you, but you can PM me. And if you want to have a debate, like these are big questions, right? They're even more beyond the focus of just how do I build a trading plan and how do I trade setups. These are like philosophical questions. And we've already answered this question in the strategic planning, but you can PM me if you want. And I might just say, well, remember when we talked about this, or remember when we talked about that. Okay, with the notion of letting your winners run, could you better explain risk adherence in regards to moving your stops to maximize potential earnings when exiting a winning trade? I know we haven't covered moving stops yet, but risk adherence is in the example trading plan, and I would like to better clarification if possible at this stage. Actually, it's interesting. The level 3ers, we just went through the module. The second week of their level 3 program, I talked to them about giving them the ability to move stops. It's imperative at this stage of your trading, especially if you're beginning, right, that number one, you just force yourself to learn that process. And if your trading plan says, all right, I'm going to take trade setups with 2-to-1 risk reward, I want you to get into the habit of booking those 2-to-1 wins. And especially for new people to trading, and I just covered this with the level 3ers, when you start injecting the ability, the discretion to move your stops, to quote unquote maximize your profits, you are injecting more variables, you are injecting more potential for problems. And you know the old adage, right? Anytime you add more moving parts to an equation, there's more possibility of problems and failure. I would really like, you learning how to crawl, then stand up. I would like for this level 1 program that we just focus on booking and actually showing me, Brian, I made my 2-to-1. I doubled my money. If it's a sell half on a double strategy, I bought, there's my double, I booked the trade, rock on. As soon as you start injecting the ability to quote unquote maximize potential earnings, you are leaving yourself open to making mistakes. And that's dangerous at your stage. Just show me a good couple months of you just banging out 2-to-1s, sell halves on doubles, whatever. If you want to go sell a third on a triple, fine. Make damn sure you're doing little old lady nanny nibbles kind of risk management. I really don't think it's in your best interest at this point in your education to even be considering moving stops. I really don't. And I think I'm going to leave it at that. I know you don't like that answer. That's not the answer that you want. But if you want to work with me for the next 6 months, in 6 months' time, I'll show you all the different strategies that I recommend to my veterans on how to stay in trades as long as possible. Okay, keeping all coins on an exchange is a risky business. You're telling me, Mount Gox. The best option would be to wallet, cold storage, etc. Would you work this in a trading plan? Absolutely. I mean, really, the whole point of the trading plan is just to simply reduce anxiety. Try and make this as easy on yourself as possible. Hint, hint, hint. Definitely a question on the final exam. So if, and we have lots of students that are like super programmer, developer people. And they know how risky these damn exchanges are, far more than me. And they look at me and they go, Brian, you're crazy for leaving that much money on these exchanges. But, everybody knows how much risk I've got in the game, right? I started this crazy little portfolio with $500. So do I really care? Is it really that big of a deal? This is better in my eyes as a good demonstration. And if the whole fucking thing blows up, then I think that's going to be an awesome chapter in the book. We're diversified across exchanges, and maybe I have a little too much in Trex. That's another conversation. I actually wouldn't mind, to be honest with you, pulling a couple $100,000 out and just putting it in cash. But am I going to argue this point with you? Absolutely not. If you are like, Brian, I like sleeping at night. I don't like keeping my money on these exchanges, these centralized exchanges. I'm worried about another Gox or, Crapsy. Does everybody remember Crapsy? It can happen, right? Everybody thought that Binance just last week was another one of these scams. If you want to move your coins into cold storage wallets, totally fine by me. Nothing wrong with that whatsoever. Number 12. And how are we doing on time? How are you doing there, James? You feeling pretty good? Yeah, fuck, man, Chris. I lost a shitload on that crapsy too, man. Just a heads up, we are 1 hour, 10 minutes in. What do you think? Should we take a couple minute break or keep forging ahead, guys? Holy Jesus, look how many questions we got. Suppose we should probably maybe do half, shoot for half tonight. So, 1.5 hours in now, yeah. So we got a total questions. What is our total here? Jesus Christ, you guys asked a lot of questions. So we're up to 34. So that means halfway point would be what, about 16, 17, 18, I guess. 15, yeah, somewhere in there. That's not bad. Okay, so where are we? We're at 12. All right, why don't we take a 2-minute break? It is 5:26. Yeah, we'll make it 3 minutes. I'll be generous. I will come back on at 5:29. All right, here we are, 5:28. We should probably, oh, I don't have a little, oh, here we go. And we are back. Hope everybody had a chance to go take a quick tinkle. All right, so let's keep moving on here. When using the risk reward charting tool, I realize it must be drawn to at least the 2-to-1 risk reward, which is easy enough to work out based on the TA risk level. But above the 2-to-1 risk reward, how do we work out where to draw a relative risk top for the trade? So primarily based on previous movements, resistance levels, fib levels, setup, etc. I'm not quite sure where you're going with that, but I will say that, and when we get into the candy store, we'll talk a bit more about this in detail. But what I typically suggest to people is, where are we here? Maybe we'll do it over here. Actually, this isn't bad. If I was, let's say we were thinking about buying off of the bottom here. And what am I showing on the screen? I got to make sure I'm showing the right screen because I don't think I am I? Nope, I'm not. Okay, so I was looking at this here. And actually, you know what? Why don't we do one of these? This isn't bad. Which one should we do? Let's do. Actually, we did this cute little one. So why don't we do this? So our simple rule of thumb when coming up with price objectives going forward is the 50% rule. It's one of these sort of time-tested principles. And usually I like to use the entire range. So if I was thinking about buying down here and I was thinking about profit objectives, I would start by just simply asking, what is a 50% retracement of the previous move? See how I did that? And this is very natural. You guys have probably, I don't know whether you've ever heard the expression before, but there's an old expression in the market that says bulls make money, bears make money, but pigs, they get slaughtered. What does that mean? Well, if I had gone and say bought here, right? I'm feeling pretty good. Market's moving up. I got a nice profit. I did pretty well. I had the balls to go in and just, I don't know, let's say buy that level there. So you can see market's moving in my favor. Actually, I guess, I'm saying something like that, right? So market's moving in my favor. Oh, I'm taking a little bit of heat here. But if I use the 50% level as a nice objective, then I'm not being too greedy when I look to take profits. And quite often, like this one here, if these lows hold, I could very easily see this come up, test. We have an old expression in the market, wicks and tails like to be eaten. I see this big old wick right here that sure looks to me like it wants to be eaten. But notice how that sort of corresponds with the 50% level. Really good example, Litecoin recently. So if we go to a daily chart, and you see that we have this bottom, market came down, and notice off of this low, there's the 50% rule. That's the exact same thing we just talked about a moment ago. So it's such a great way to just simply come up with a nice, realistic, simple target that you can use over and over again. And you notice that this thing bounced, doink, right off the 50% level and then stalled. So great example. I'm not being too greedy. I'm not shooting for a price objective up here. 50% level. Bulls make money, bears make money, pigs get slaughtered. Here, I'm not being a pig. Nice and conservative. And you can see, nice tag hit. Merry Christmas. You're done. So the cool part about this is, I don't know, maybe you'll hunt this fractal that fired right here. You'll learn about fractals later on. Quite often what we see in this particular case is only 1.5 risk reward. Maybe we could have found a better entry down in here, but that 50% level, awesome. Such a perfect, simple little tool. And it just keeps you honest. It's simple, straightforward. Oh, hey, look, did Bitcoin break out through the top? Well, that's encouraging. Yay. In fact, here, it's probably Bitcoin right now. We have a nice big range. Let's see if we can zoom out here. There is 38.2 off of the entire range. So the question ultimately is, if I had gone and bought down here, what's a realistic price objective? Again, bulls make money, bears make money, pigs get slaughtered. We'll use the 50% rule. You see that sitting at 12,945. If you had hunted longs off the bottom here and you were looking to take profits, I would have no problem whatsoever with you using the 50% level as an objective. Totally awesome. So that, and we'll talk lots about this in the sort of the fibs part of the course and setups and all that kind of stuff. What are really good targeting tools? Well, we gave you a little treat there. Very simply put, our rule of thumb targeting tool is the 50% rule. Naturally, markets like to bounce, right? So, even through this mess, if you had bought down here and you were like, well, what the hell would be a good sort of conservative profit objective? And you see that looking for that 50% bounce was very realistic, right? You didn't get the exact top, but at the same time, too, you didn't chicken shit and just take profits. Here, you got a nice 50% of this range. I hope that helps. This right here, right? Really good example. coming back down, there's the 50% level. So, maybe you were hunting shorts up here. Boom. Take profits at 50%. Does that answer that question? I hope that answers that question. That's a tough one. How do we work out where to draw a realistic reward objective for the trade? And my answer is 50% rule. All right, I'll bold that. 50%. Awesome. Okay, number 13, lucky 13. In the members lounge, TRI's users constantly post their nanny nibbles trade entries when price of shaltcoins dips in RLC or below without any other trade structure, indicator, or divergences to justify the purchase whatsoever. Surely this buy-in strategy, even less than 1% for the purchase, would end up resulting in riskier investment overall if you constantly take this approach. You would think, but what you have to understand is, and actually this is a comment on last week's module. If we identify a trading range, who can tell me? Let's see, can I show you here? I don't know if I can show you here or not. Well, no, we can do it even on the stock market. So here's the stock market, right? Ooh, look at that damn stock market. That's a big market. And we're going to draw a fib from this high back to this low. If we've established that this is broken down here, and we've also established that this is a key pivot low, if I force myself to go in and buy down in here, who can tell me what is the statistical odds that the market will turn down here, not break this low, and actually turn back up? Anybody know what the statistical odds are? You should, coming out of last week's module. Anyone? Do 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 do. I wonder how long the delay is. 66. Nope. Hey, Bill got it. 70 to 80% of the time. Super important, Burns. Maybe you ought to go back and watch that video again. 70 to 80%. So try and remember that. Lose the 60, 70 to 80%. That might be as high as 75%, might be as high as 79%, it might even be 80, 81%. But it's up in that area. Well, but this is, yes, Robert, and frankly, thank you for doing that. But I'm just trying to answer this guy's question, whoever this is. So somebody here is saying, well, surely this isn't going to work. And the answer, the reason why it does work is that because 70 to 80% of the time when the market comes down and tests the bottom end of the range, it will hold the bottom and it will turn back up and it will trade back up to the top end of the range. So that's the answer to that. Now, the issue here, and this is a very good comment. Very, very good comment. Because you look at the people in the lounge and you go, Brian's trying to get me to do 3 reasons for a trade. And I just see these guys fucking gaps and reload zones just working bids. How can they feel so confident in doing that? And the answer is that they've played the game enough that subconsciously they know that the market will turn there. But that's asking too much of you. I don't mean to be rude, but psychologically, I don't think you can handle it, especially if you're brand new to trading. Just getting you to go and blindly buy levels is very psychologically taxing. So how are we going to make this easy? Because keep in mind, this is a course. And at the end of the course, you might be like, all right, TRI, I'm heading off to the sunset. Have a great day, guys. I'm done. And I won't be insulted if you take the course and you're like, okay, I'm done. So that means that you have to be able to leave this course at the end of this course psychologically ready, willing, able to go out into the market and trade. But if you take this course and I just say, oh, fuck, just go and blindly buy at those levels, unless you sit there for 6-8 months banging out these trades and seeing, okay, I see what is happening here, then frankly speaking, I don't think you're going to see that. And you're, maybe the first half dozen trades don't work. And you're going to be sitting here going, this is a waste of my time. So how can we build as much edge as possible for you guys? Because that's the whole point of this. We want to try and stack the odds as much in your favor as possible. So if we wait for the levels, which all these advanced guys are all just zipping in there and doing, but if we wait for the levels and we wait for signs of divergence, which you've already now sort of learned, but of course we're going to go into great detail in the candy store, and you wait for structure, and we do have some structural tools, head and shoulders, triangles, M's and W's. We're going to learn more structural tools, candlesticks, fractals, the way the universe is built. If we combine all of these together, then it's going to increase the odds of success for you when you do take these trades. And yes, it's a little bit slower, but I'm trying to set you up for success. I hope that answers that question. It's in your best interest to go slowly and just only take the ideas that are just fucking cherry picks. They got location, they got divergence, they got structure. Now the odds of me actually winning at this game are heavily stacked in my favor rather than stacked against me. I hope that helps answer that question. It's a very good question. Don't get me wrong at all. Very good. And a layman coming from outside the industry, this makes perfect sense. You'd be like, why are you buying against lows? There's no way that the bottom of those ranges are going to hold. But, I showed you this chart. This chart, if anything, is an absolute perfect example of crypto. Holy, look at the fucking thing go. This is crypto in a nutshell, if there ever was a crypto. So do you see how basically price came right back down against the bottom end of the range? Because I'm very comfortable, I'm just like, fuck it, man. I want to work my bid. I got to get in down here. And I just sat there and just picked my nose for like what? Almost 6 months. I just was sitting there picking my nose. Damn, it's getting awfully bloody. But then all of a sudden, hey, I hit pay dirt. And woohoo! That's crazy, eh? I mean, that's just nuts. But I hope whoever answered that question, you can see the power of just coming in and buying off of low ends of ranges. Now, you could have said, okay, well, Brian, I don't know whether I really believe. But what we're going to learn later on is, we'll look at these indicators. We have signs of divergence coming in here. Market's making lower lows, but the indicators are not. We also have sign of buyers coming in here, which you will learn. So we also have a sign of divergence from volume. You will learn all of this. And then finally, if you're like, well, Brian, I can't just buy levels blindly. Well, hopefully what you see here is, we went down, and really, if we change this to a line chart, and this is what I wanted all of you guys doing, but if we change this to a line chart, hopefully now you see, oh, well, geez, it looks like the W came in right here. And you see the W down in here? There it goes. Down, up, down, breakout. So you could have just gone and blindly bought the bottom end of the range. Turns out, I just sat there. Nanny nibbles. Didn't have to time my purchase too much. Right? Just sat and let my money work. And who's laughing now? And you got to understand, this is so crypto. This fucking thing might go 100x here by the end of today. It's just so typical crypto. Isn't that incredible? I mean, gee whiz, that's nuts. It's almost enough to make you laugh. And look how high this darn thing has gone. I mean, the irony of it all is we're not even at an all-time highs. Look how high this thing used to be. Are they going to go up and eat that wick? Holy Jesus. Wow. Julian's going to be a pretty happy camper here. So, 70, 80% of the time. Okay, I think I've talked about this enough. And I'm sitting here just tooting my own horn. So I should put that away. So to simply answer your question, it's worth it just to simply go in and place bids against low ends or ranges. But I think for you guys, so that you psychologically can set yourself up for success, we're going to go through the process of what does a setup, the 3 stages, the process look like. Get you really good at that, nice and confident, your subconscious beliefs. And then in the next cycle, you're going to be like, well, fuck, I know when it dips down the reload zone, I have pretty good odds that it'll work. And so I'm okay with just working my bids. But I don't want you to start that way. All right. Wow, that was a big question. All right. So let's take another sip of my orange juice. And if I was drinking this much whiskey, man, I'd probably be on the floor. All right, risk manager. Jade, can you tell me what the risk model is? That guy, I know that. You're the goods, man. Right? All right, let's keep moving on here. Okay, should the 5% rule always be relative to my current account balance for the trading plan? I.e., if I lose a few in a row, should I keep making smaller bets? Well, I would actually argue that this is a rule that you just are never allowed to break, ever. I would actually argue it's in your best interest to start off with a fraction of this 5%. Right? Maybe even risk 1.5%, 2%. You are just never, ever, ever allowed to let any loss in your portfolio go beyond 5%. The great part about it with like Nanny Nibble, Little Old Lady, if you just go in there and do 1% nibbles, 1.5%, maybe 2% nibbles, you can't break this rule. It's impossible. But the bottom line here is, like Joe Sixpack, he's going to put 10% of his portfolio into a trade. Well, if it moves 50% against him, he's got to get the fuck out. I think it's a good idea, whatever risk model you are going to use, that it be on the current balance. So if you started with $100, 5% risk is $5. You, let's say, lose 2 trades in a row. Boom, you're down to $90 now. I think it's a good idea that you knock that down to like $4.50 that you can take risk. I definitely think that's a floating balance. The only problem with this is it's a bit of a trap. I would not use the current equity of, say, your shitcoins to value that number. Because obviously through bull times in the market, these shit coins are going to be inflated in value and your account's going to seem like it's worth a hell of a lot more. Then, of course, during bear markets, the market's going to come off and your account value is going to go down just because of the volatility of the shalt coins. And so as a result, you look at, oh, geez, I was risking that much and wow, that's way too much. And now, when can see the whiskey doing its magic on Brian? Oh, okay. Oh, I remember when I was doing my little funny drunk talk there. So I think, first and foremost, this is just the absolute, you're never allowed to break this rule. I would actually argue you want to start with a fraction of this. And then, yeah, based on what your portfolio value is, and if you have to book a few losers in a row, good idea to scale things back. And frankly speaking, I want you paper trading to begin with. Any setup that we get to the point where you're like, okay, I think I'm ready to do this setup. I want to see 20 paper trades before you even risk any money. It's really in your best interest, guys. Seriously. Okay, could you explain why the Joe Sixpack risk strategy gives more reward than the little old lady risk strategy? Well, because Joe Sixpack's going to put twice as much money into the trade. In fact, I had this funny little drawing. Let's see if I can find it here for you. I know it's on the old site. I just don't know whether I have it available here for you. Where the hell? Yeah, Trader's Math. Here we are. All right, have you seen this image? I don't know whether you guys have seen this. So, this is sort of how we break down like El Tangonator and what kind of money it is I'm looking for, and so how am I going to sort of frame my year going forward. That's not actually what I wanted to show you. I want to show you something. Yeah, but that's not really the one I wanted to show you. The one I wanted to show you, but I don't even know if I have it here. Do I have the four risk takers? Maybe it's in the is it in the presentation material? I only have this. Oh, that sucks. Anyway, I think in the video I did the whole breakdown on the screen for you. But the reason why Joe Sixpack does better is because Joe Sixpack's taking 10% of his portfolio and putting it into a name. Little old lady, she's only putting 5% of her portfolio, so twice as much. So if little old lady had $100, right, she'd take $5 and put it into an idea. Joe Sixpack, he would take $10 of the $100 and put it in the idea. So as a result, twice the size of the bet. Could be a pretty simple answer. I remember you saying not too long ago that your LOL portfolio balance was not as important to you compared to the fact that you did it without taking more than 5% risk on any trade. Yeah, I think so. Yeah. Is that because you take less risk than the industry standard? What's the industry standard? I don't know who that is. Or because you're appealing to the public who would normally not risk to a 5% rule? I'm not quite sure I understand what the question is. Is that because you take less risk than the industry standard? No, 5% rule is actually pretty universal. So that's basically that's pretty commonplace standard in the market. The public, usually what the public does is the public, let's say I inherit $5,000 from Uncle Bob who died, right? They'll just take $5,000 and they'll just throw it into an idea. All right, I'm going to go buy $5,000 worth of Ripple. Right? It goes up 10%. Ooh, look at me. I'm so smart. Goes down 20%. Oh, geez, I just lost $1,000 on Uncle Bob's money. When that's not how professionals operate in the market. It's just too much risk in any one particular idea. Now, you could take that $5,000 and put it into an idea. Who can tell me? Let's say $5,000 stock costs, I don't know, let's say, let's just say $1. Right? So stock's $1 a share, or the coin is $1. I don't even know if you're gonna, it's priced in US dollars, right? So you're gonna go buy 5,000 coins. At what dollar figure do we have to actually liquidate that position? And not break Brian's magic rule. So I bought 5,000 coins at $1 a coin for a total of 5,000 invested. What price do I have to man up, lady up, whatever, close the position and walk away? Very good, Joey. $47.50, $250 loss on that $5,000 investment. You better fucking smarten up. Now, that's a pretty small window of error, isn't it? Well, if the price goes to zero, what's your $5,000 worth, Burns? Do you have any of Uncle Bob's money left? So if you are a professional manager, if you want to, make money from trading, approach this as a professional, you can't risk to zero. $5,000 is not 5%. Well, $5,000 is our principal, right? The question ultimately is, how are we going to manage that $5,000? If you're going to go through the whole fucking thing into one idea, then you can risk $250, which just isn't that much money. In essence, that's our dollar a coin idea, buying 5,000 coins. At 94 cents, I have to man up and say, I was wrong. Get me the hell out of here. The sad thing is, a lot of people just they can't do that. I would even argue that if you did want to take that approach, I would say at 97 cents, you better really start asking yourself, why the fuck am I in this thing? I think it's a lot easier if you did like that, whatever, at $1 a coin, that you just take $250 of that $5,000 and just go buy it. Do you now see, Burns, that if you took $250 and we said the coin was $1, right? So you're going to buy 250 of these things as opposed to 5,000. Now on those 250 coins, you can let it go to zero, and it's not the end of the world. Does everybody understand the difference? Because really, this is all this conversation about what type of risk taker are you? Exactly. Very, very well said, Burns. Okay. Well, I wouldn't say not relevant. That's kind of unfair. I think, we talked a little bit about the 5% rule. And I think I've answered this. Okay, isn't trading with the mindset to accumulate a large amount of Bitcoin inherently risky? This whole fucking thing is risky, guys. You want guaranteed? I'll show you 3%. That's what we used to say back in the 80s when interest rates were even remotely close to that level. As it relies purely on the idea that Bitcoin will eventually be more than it is now. Absolutely, without a shadow of a doubt. The interesting thing, though, and you tell me, if I went and bought one Bitcoin, even at, say, $20,000 a Bitcoin, and just roughly speaking, if I bought one Bitcoin at $20,000 a Bitcoin, what's my investment worth now? About 11,000. It's basically fallen in half, right? Everybody with me? Everybody follow my logic here? Down 50%. Oh, shitty. Right? But what if I had gone and bought this fucking thing with my one Bitcoin down here or wherever, right? Oh, yeah, okay, that's it. Right, say right here, right? Because that's where Bitcoin went nuts. So you tell me, if I had put one Bitcoin into this thing right here, and Bitcoin's 20 grand, am I ahead of the game now? This is now, what are we? Let's say what the hell, you joined me there at 1,000. So now we're at 18x my investment. What do you think? Am I doing okay? Does it really make that big of a difference if Bitcoin fell 50% in value? Anyone? This is why I do the altcoins, because these returns are ridiculous. This is nuts. But what the fuck? Even if Bitcoin falls half in value, I'm still way, way ahead of the game. And like I said, this is why I play this silly game. So to answer your question, if it's just a zero-sum game with Bitcoin, you're absolutely right. There's a ton of risk involved in this. But the irony of it all is if you can actually outperform Bitcoin's decline by owning other cryptos, doubles, triples, quadruples, whatever, well, You can actually even come out of the game even with Bitcoin being down. I understand that using LOL risk model, you don't need a stop levels as you can risk the entire 5%. But how do you track your win-loss percentage if there is no losing criteria other than, I guess, if the coin goes to zero and dies completely? Pretty much. The only way that I know that an idea doesn't work with the little old lady strategy is the coin gets delisted, goes off the board. Even if it's worth 1 sat, the trade is still alive because of exactly this, right? And I can show you tons of these. This isn't you look at this and you go, that's crazy, man. That doesn't happen. But the irony of it all is that actually this is pretty normal for crypto. So I could have bought here, and a week or two later, people would be like, "Oh, Brian, that's a shitty idea, man. You suck. You totally suck, man. You suck. You suck." Okay, well maybe you're not so. Oh well. Okay. Oh fuck. I guess you know what you're doing. Okay. So the point here is I get lots of ideas that I just put my money to work, and maybe they sit underwater for 6 months, 8 months, and then all the fucking out of nowhere, the thing just goes nuts. So yeah, I mean, to answer your question, a lot of the stuff that I buy, it just sits there and it doesn't do anything. But it's a very good question. And really, I would argue the cool part about what we do is we have so many doubles, so many triples, right? I mean, you see what their portfolio has done percentage wise. If anything, I'm looking for coins that are going off the board. I'm looking for losers because I need to find capital losses to offset these capital gains. So I don't mind having a whack of losers that go off the board. If anything, it's good. Try to figure that one out. Yeah, there you go. So not, right? Not's perfect. Yeah. And so not, and then what's the other fucking one that we were joking about today? Not is Brian Kelly's gift to the world, eh? Oh, Max coin. Max Kaiser, his fucking coins there. Mind you, Max is still alive. And the irony of it all is I wouldn't even be surprised if Not will come back to life at some point. It wouldn't surprise me one bit. Okay, how do we know the option is for 100 SPY shares? Is it always the case? Yeah, so stock, SPY is an ETF, or what we call an exchange traded fund. And if you go to the Chicago Board Option Exchange, you type in SPY, it comes down like this, right? You see ETF Trust, and the default to this is 100 shares. They're always 100 shares. Why is the option price displayed for an individual share and not the whole 100 lot? Probably just convenience. I don't know. If anything, that would be a good question. We should call up the Chicago Board Options Exchange. Say, what the fuck is your problem? But I think it's probably just convenience. And it also standardization, right? So everybody knows that it's the option is on 100 shares. So if anything, it's probably important that you actually, it's not 100 lot, it's 100 shares. And 100 shares is actually what's called a board lot. So that's probably why they do it that way. Is in classic stock trading terms, stocks that are option eligible, a board lot is 100 shares. So that's probably why they do it that way. Okay, well, what do you think? James says that we've gone past 2 hours. So we made it up to question 20, and it looks like we'll have about 33 in total. So that is more than half. Shall we call it a day, James? What do you think? Did you guys feel like you got good value out of this conversation here tonight? All right, so somebody's officially marking end of Monday. There you go. Thank you very much. So why don't we leave it at that? Try and save Brian's voice. Sure hope everybody's getting good value out of the course program. Please reach out to us and let us know if there's any way we can help you anymore. We've got a whole team of people that's super PMA people. Julian's done really a fantastic job trying to automate this as much as possible for you guys. So hats off to him. TAs, and we're surrounded by just a fucking bunch of really cool people here. So, if anything, just get to know them. These are such nice people. So thank you very much, James. Thank you, Mr. Typer or Miss Typer, whoever that is. Thank you very much for the questions. Hopefully, I've given you very straightforward answers that are actionable and that you can use. And we got to keep seeing those trading plans keep filling out, right? So by now, we should all have a pretty good idea of who we are, why we're doing this, where we want to go, what does the world look like, and what's the world going to look like for the next 20 years. We should have a pretty good idea of what markets we're interested in. If you want to do leveraged, margin, OK coin, MEX trading, and little old lady altcoin trading, great. You need two separate trading plans. Point of the matter here, in our tactical planning, we should identify clearly what market we're trading, what kind of money we're working with. Obviously, now with today's conversation, what risk parameters I'm going to be taking given the particular plan. We should have given serious thought to additional considerations, what time of day I'm trading, what kind of technology needs I have. Have I given consideration to the risks of the market and any sort of vulnerabilities that I might personally have? Am I disciplined? Am I patient? Whatever. The only thing that's missing now from your trading plan is this one line. What are my setups? What is actually going to frame my behavior in the market? So let's see those plans. Basically, you've got another couple months working with me. You have the framework to start working and building on this, but I need to see you moving forward. All right. Okay, why don't we leave it at that for today? We'll do another session on Wednesday. So by all means, if you want to participate in that, totally awesome. I think we're going to have to add these page references, I think, are out of whack now. But nonetheless, great job on communally supporting each other, seeing just some fantastic work amongst peers. So just keep on keeping on. And if you have more questions, make sure to write them down. And we'll do it all again on Wednesday. All right, everybody, have yourselves a great evening. All the best, and bye for now.